Corporate profits are at record highs, but 4 factors could sink them, according to a New York Times analysis by Peter Coy. In the last quarter of 2025, pre-tax corporate profits reached their highest share of gross domestic product since record-keeping began in 1947. This happened even though economic growth and job creation slowed to a crawl. Wall Street analysts are predicting profits will be even stronger this year despite dismal consumer sentiment and high energy costs. Morgan Stanley's chief investment officer Mike Wilson is sticking to his forecast that S&P 500 earnings will rise 17% in 2026. Optimism that the profit juggernaut will keep rolling drove the S&P 500 to a record high this week. But to know if it will continue, you have to explain why it's happening in the first place, and experts have different ideas. Many share a belief that the headroom for further profit growth is shrinking. One leading theory points to technology. Suppliers of networking gear got a huge boost during and after the COVID-19 pandemic, and they're getting an even bigger boost from the artificial intelligence boom. Veteran market strategist Jim Paulson says the tech sector has experienced much faster growth in stock prices and measured productivity than the rest of the economy. Surprisingly, though, strong profit growth hasn't been confined to tech. An analysis by Ricardo Marto, an economist at the Federal Reserve Bank of St. Louis, found the recent surge in corporate profits was driven by retail and wholesale trade, construction, manufacturing, and healthcare, not tech. Marto says the surge continued across most of those industries over the past year. One possible explanation is that tech investment is genuinely paying off outside the tech sector. Artificial intelligence is beginning to boost profits by automating some jobs out of existence. And before AI, there was the post-pandemic productivity dividend. KPMG chief economist Diane Swank notes that tools like video conferencing, which sat unused before COVID, suddenly got applied everywhere. Another factor supporting profits is the absence of recessions. Recessions crush profits far more than they reduce wages, so every year without one is a year the profit share holds up. Outside of the pandemic shock in 2020, the United States has not experienced a recession since the financial crisis ended in 2009. Yet many experts warn the window for growth is narrowing. That's the breakdown from the New York Times. Thanks for listening.